Good day, Travis here, your certified mortgage planning specialist. I wanted to record a video and send out this update on the $8,000 tax credit for first-time homebuyers or homebuyers, and the fact that it's ending here on December 1st. And so there's, it's a sense of urgency that's being created, and a lot of talk of it in the industry about, making the decision and getting off the fence and moving and looking for homes, because we get down to that deadline. It could be really scary if you're within a day or two, and then have your loan documents not close in time. So we're preparing for the worst here, and just want to get this update out to you. There's 5 key points I want to touch on today, and basically the 5 points are just that it is going to expire December 1st. 2, that this is a first-time home buyer status with the IRS is pretty broad, and they're going to touch on that. That it's a true credit. It's not a loan, or it's not a deduction. It's truly a credit you receive. 4, it's also, there's talk of being used towards down payment or closing costs. I'll decipher those 2. And the last thing, 5, is that you can amend your 2008 taxes, even though you're purchased in 2009, and receive that refund prior to you filing next year. So on the first point, the concern is that obviously this ends December 1st, and you close on December 2nd. As the law stands now, you're out. So delaying the closing by 1 day could potentially lose you $8,000. So that's a big number to consider, and not to want to mess around with those dates being around Thanksgiving and that time of year. Also, there is talk of the IRS extending this credit, and the Fed's extending this credit just simply because the money hasn't, or the credit hasn't been as effective as I thought to correct housing and stimulate housing purchases. So most likely they will extend, but I certainly would be reckless in saying assume that or wait and hope that happens, because that's an $8,000 mistake if they don't extend it for some reason. 2, first-time home buyer status is actually very broad. It simply is that if you have not claimed a primary residence as a mortgage deduction on your taxes in the last 3 years, then you are qualified as a first-time home buyer. So if you've actually owned a rental home, let's say you owned a house and you moved out and you turned it into a rental, but you've been renting in the meantime because of job transfers or something, if you have not lived in that home and it's been a rental for the last 3 years, you're still considered a first-time home buyer, because it's not your primary residence. Same thing with second homes. You can have a second home in Bend or at the coast, and if you sold your primary residence, you would still qualify for the $8,000 credit if you were to purchase a new primary residence. So that's pretty broad there. Another concern is that we've had people that have been married recently, where the one spouse did not own a home, but the other one did, and so they do not qualify for the tax credit. Even if you file separately, married filed separately, you still will not get the $8,000 credit. Unfortunately, it defaults to the married status and married person. But the good news is, if you're engaged and not legally married, or you have a partner living with you, and one is owned in the past and one hasn't, the other spouse or partner can claim the $8,000 credit because of the legal reasons there. As well as parents, I've had several parents co-sign on kids' homes as a non-occupant co-borrower, they call it, and the child gets to get the credit even though the parents currently own a primary residence. So important things to consider there. And then that's basically the main thing there. And so on the third point, it's truly a tax credit, not a deduction. So it's a truly $8,000 tax credit. The only way you would not get $8,000 is if you were to buy a home that was less than $80,000, because it's 10% of the purchase price, or $8,000, whichever is more there. So $8,000 if you bought a $75,000 condo or something, which I don't think there's too many in Oregon, but it would be, you only get $7,500 then. So that's the difference there. And also, if you earn more than $75,000 as a single person, or $150,000 as a married couple, there's a phase out at that point, where you would phase out at the $85,000 mark as a single, and at the $170,000 mark as a married couple. So that, we can talk about that more. Give me a call on that. 4 is there was talk of using the $8,000 tax credit as a bridge loan or advance on your down payment. So people that didn't have a down payment, they were hoping to use this $8,000 tax credit as their 3.5% down, like on an FHA loan. That didn't come to fruition. There were some laws against that, and got rid of some of these down payment assistance programs and these nonprofits that were assisting FHA in doing that. So those are not available as a down payment. You truly still have to put down 3.5% of your own money, or get a gift for that money. But they did make some changes where you can use that credit towards closing costs, which a lot of times there's some logistics in that, and we usually can do that anyway just by negotiating that in the sales contract. So not a real benefit there on that side of things. But I do have several people that have taken 401k loans from their work, and knowing they're going to pay back this loan as soon as the tax credit came in, and knowing that the next point is you can file an amendment and get that money back. Many people are doing that, or get a gift from a family member to plan on paying them back as well without any interest or any kind of payment there. And the fifth thing is the amended tax return. You can actually amend your taxes for 2008 if you backdate your purchase back to December 31st of 2008. It's ethical and legal. The IRS is allowing this to happen. So then you would file an amendment to your 2008 taxes with a form, which I've attached here at the bottom right of your screen here. It'll have two forms, actually the 2008 amendment for the 1040X, as well as the form needed for the $8,000 tax credit. So you file those two things. You could either go down to just a licensed tax preparer to do it, or try it yourself, or go to your CPA and have them file. It should be a small fee to do that. But right now, usually those amendments take about 8 to 12 weeks to get back. It sounds like they're backed up right now, so maybe 12 weeks to 16 weeks. But you could get that way before you file your taxes in March or April of next year. So many people have been doing that. So that's kind of the update. Like I said, I wouldn't plan on the IRS or the government extending this credit. It truly is going to end December 1st at this point. The transaction has to be closed by then. Like I said, a day later, you lose the $8,000, so it's a tricky date to be playing with. If you have any questions, though, please call me at 503-517-8758 anytime, or just tune in to neliton.com, Neliton.com, for more questions on our live interactive website there for our clients. Look forward to serving you. Have a great day and be blessed.